Welcome back, everyone. Today we're jumping right into an explainer on a topic that honestly leaves a lot of traders and investors scratching their heads. We're going to decode a pretty complex framework from the National Stock Exchange of India, specifically diving into something called the Additional Surveillance Measure, or ASM for short. All right, let's just get right into it. If you've been in the markets for any length of time, you've probably experienced this absolute frustration. You go to trade a stock you've been eyeing, and out of literally nowhere, your broker demands a 100% margin. Boom. Your leverage is totally gone. The price bands are entirely restricted, and you're left wondering, wait, what just happened? Well, you didn't actually do anything wrong, but that stock you're looking at, it likely just tripped a massive regulatory wire. That tripwire is the Additional Surveillance Measure, the ASM. Basically, it's a dynamic framework jointly decided by SEBI, the Securities and Exchange Board of India, and the exchanges themselves. They use these highly objective, purely mathematical parameters, we're talking things like price variation and volatility, to monitor and control securities that are, well, raising some surveillance concerns. Now, to understand exactly how this works, we're going straight to the ultimate authority. This explainer today is based entirely on the official framework and FAQ document published directly by the NSE itself. We aren't looking at rumors or, trader folklore here. We are looking directly at the actual rulebook. And what's really interesting here is the core philosophy behind this whole framework. The exchange explicitly states their main objective is to alert and advise investors to be extra cautious and to carry out necessary due diligence. So the ASM isn't actually designed as a punishment for a company. Think of it more like a mandatory systemic speed bump. It's installed purely for market safety when a stock starts moving just a little too recklessly. So how exactly are these speed bumps deployed? We're going to break this explainer down into 6 parts. 1. Safeguarding market integrity. 2. Triggers for ASM shortlisting. 3. The long-term ASM stages. 4. Rules for derivatives. 5. The short-term ASM. And finally, 6. How stocks exit ASM. Okay, starting with Section 1, Safeguarding Market Integrity. Imagine a stock that's suddenly seen these wild, unpredictable swings in price and volume. Where does ASM fit into the broader picture of keeping the market safe? Well, the crucial point to remember is that ASM doesn't work alone. It's part of an ecosystem. The NSE uses various enhanced surveillance measures. ASM operates right alongside graded surveillance measures, or GSM, and the transfer of securities to the trade-for-trade segment. In fact, the rules are very clear. If a security is already under GSM or in the trade-for-trade segment, it's completely excluded from the long-term ASM shortlisting process. Basically, there's a strict hierarchy of surveillance going on here. Moving right along to Section 2, Triggers for ASM shortlisting. So, assuming our highly volatile hypothetical stock isn't already trapped under another measure, what actually triggers the ASM? Well, the NSE monitors a remarkably complex mathematical web. They don't just look at whether a stock went up or down. No, they're running dynamic shortlisting parameters. They're looking at high-low price variation over a few months, close-to-close price variation, volume variation against delivery percentage. They even factor in whether the PE ratio is negative or if it's double the Nifty 50's PE. And brilliantly, a lot of these price variation formulas actively factor in the beta of the stock multiplied by the Nifty 50's variation. That basically means the exchange actually accounts for how the broader market is moving when judging a single stock's individual volatility. But amidst all those complex formulas, there's one specific number that shows up over and over again in the entry criteria: 25. For a stock to be flagged under many of the main long-term ASM criteria, the concentration of the top 25 clients must account for 25% or more of the combined trading volume across both the NSE and BSE over the last 30 days. Think about that. The exchange is highly focused on figuring out whether a tiny handful of traders are the ones driving all this massive volume. Which brings us to Section 3, the long-term ASM stages. Okay, so our hypothetical stock has officially hit the triggers. That heavy concentration of clients and those wild price variations have totally caught the system's attention. Now, we immediately start to see the tightening grip of the exchange. Once a stock hits stage I, starting from the T+3 day, the applicable margin immediately hits 100%. If the stock keeps up its volatile behavior, specifically by hitting variation triggers for 5 consecutive trading days, it drops into stage 2. Here, the price band is reduced to the next lower level. 5 more consecutive days of triggering those criteria, welcome to stage 3, where the price band shrinks even further. And if that stock continues to trigger the conditions for another 5 consecutive trading days while it's in stage 3, it hits a concrete wall. Stage 4. The impact here is absolutely severe. Settlement for all clients shifts strictly to a gross basis, the margin remains locked at 100%, and the stock is restricted to a super tight 5% price band. So even if it was originally a stock that enjoyed a 20% band, in Stage 4, it is completely locked down. Next up is Section 4, Rules for Derivatives. Now, you might be wondering, well, what if I trade options or futures? Good question. The NSE actually applies a slightly different framework if a stock has derivative products. In Stage 1, while the underlying equity margin jumps straight to 100%, the F&O contracts margin is set to 50%, or the existing total margin if that happens to be higher. But the real penalty for derivatives isn't just about margins. It's really about the market-wide position limit, or MWPL. Take a look at this dummy illustration provided directly by the NSE. In Stage 2, the MWPL is slashed down to 75% of the applicable limit. In Stage 3, it's slashed even further down to 50%. So think about it. If the current open interest is 650, but the newly restricted limit in Stage 3 suddenly drops to 500, you have a massive squeeze on your hands. And it gets stricter too. If a derivative stock hits Stage 4, absolutely no fresh contracts can be issued. Period. Once the existing contracts expire, that script functions exactly like a regular non-derivative stock. Let's look at Section 5, the short-term ASM. We've just seen the long-term tightening grip, right? But the NSE also has a much faster response mechanism. The short-term ASM is designed specifically to catch sudden, massive price variations over just 5 or 15 trading days. Because it's a rapid response net, the review timeline is also incredibly rapid. A stock placed here is retained for a minimum period of 5 or 15 trading days, depending on the stage and criteria, and it becomes eligible for review on the 6th or 16th trading day. Now, if it doesn't meet the entry criteria on that review date, it moves right out of the short-term framework, just like that. But here's a really fascinating feature that's unique to Stage 1 of the short-term ASM. Upon identification, the exchange actively goes and seeks clarification from the company about any corporate announcements that haven't been disseminated to the market yet. The goal here is pure transparency. They want to ensure insiders aren't out there trading on secret news. That clarification, along with the stock status, is then publicly displayed right on a surveillance dashboard on the exchange's website. Finally, we arrive at Section 6, how stocks exit ASM. So let's say our stock has survived the scrutiny, the volatility has finally died down, and it's time to get out of the penalty box. Well, if a stock made it all the way to Stage 4 of the long-term ASM, the exit is going to take a while. The mandatory minimum retention period for a stock in Stage 4 is 90 calendar days. Yep, 90 days. It must serve that entire time before it's even eligible for a review to step down. And notice I just said step down. That's because the exit process isn't sudden at all. It's a strict, stage-wise exit. A stock in Stage 4 that no longer meets the criteria moves down to Stage 3. Then, assuming conditions remain stable during its weekly reviews, it moves from Stage 3 to 2, then 2 to 1, and finally out of the framework entirely. It literally has to slowly walk back down the exact same stairs it climbed to get into trouble in the first place. Once a stock completely exits Stage 1, its price band is automatically reinstated to whatever it was before it got shortlisted for ASM. Sounds great, right? But there is a catch. If during this whole time the stock was caught up in another surveillance measure, like the graded surveillance measure we mentioned earlier, that other framework actually takes precedence. That means its stricter price bands will prevail until it clears that measure too. And that brings us to the end of our deep dive into the NSE's additional surveillance measure. We've seen the math, the stages, and the very strict rules governing margins and position limits. It really leaves us with a compelling thought to reflect on. The next time you go to trade and you hit that 100% margin requirement out of nowhere, do you see these dynamic speed bumps as an annoying restriction on your trading freedom? Or are they the ultimate, absolutely necessary safety net, ensuring the integrity of the entire market for all of us? Something to keep in mind the next time you analyze your trades. Thank you so much for joining me on this explainer, and as always, keep learning.